Hey, what's up, stock compounders? Brad here. So Michael Burry just released his Q1 holdings yesterday via his 13F filing. We can see that here through the website Dataroma. You can see there's a lot of activity, okay, many new buys and a couple additions in addition to some trimming. So today I just want to take you through kind of how I make sense of some of these positions. And where we're going to start, there's sort of Michael Burry's investment framework that was posted by Brandon Balow. It's actually pinned at the top of his Twitter profile. So I want to read through this. It's going to help us navigate, what Michael Burry is seeing in some of these positions. He says, my strategy isn't very complex. I try to buy shares of unpopular companies when they look like roadkill and sell them when they've been polished up a bit. His weapon of choice is research. It's 100% based on the concept of a margin of safety as introduced in the book Security Analysis. By now, he has his own version of those techniques, but the net is he wants to protect his downside to prevent permanent loss of capital. Okay. I care little about the level of the general market and put few restrictions on potential investments. Whatever market cap, it doesn't matter. If I can find value, it becomes a candidate for the portfolio. I have found that in general, the market delights in throwing babies out with the bathwater. So I find out of favor industries a particularly fertile ground for best of breed shares at steep discounts. How do I determine the discount? Usually focus on free cash flow and enterprise value. Okay. So just to round out the discussion here, let's look at the bottom. I like to hold 12 to 18 stocks diversified among various depressed industries, tend to be fully invested. So that's interesting. We're going to come back to that fully invested. This number seems to provide enough room for my best ideas while smoothing out volatility. Not that I feel volatility is related to risk, but I have this heartburn problem and don't need the extra stress. Whether I'm at 50% or 100% or 200% in terms of turnover matters little. I'm not afraid to sell when a stock has a quick 40 to 50% pop. As for when to buy, I mix some bare bones technical analysis into my strategy. I prefer to buy within 10 to 15% of a 52-week low. We're going to be revisiting that quite a bit in this video. That has shown itself to offer some price support. That's the contrarian part of me. And if a stock, other than the rare birds, breaks to a new low, in most cases, I cut the loss. That's the practical part. And we're going to see one of Burry's holdings, I'm guessing he's already gotten rid of because it broke through to a new low. I balance the fact that I am fundamentally turning my back on potentially greater value with the fact that since implementing this rule, I haven't had a single misfortune blow up my entire portfolio. So this is something value investors don't talk much about, right? Kind of having a stop loss and using technical analysis to decide when to exit a position if it seems like it was a mistake. Okay. So, and Brandon summarized these tweets. Let's see if I can get to that. It's not really cooperating. Come on, Twitter, you can do it. Okay, well, it's not going to work. That's okay. That's enough from that. Now, so I made a table. Okay, I love making tables. I'm sort of an Excel geek. Don't tell Monish Pabrai. I'm not doing valuation here, though, so it's probably okay. So these are kind of the top 12 bets in Q1 in terms of how much money Burry put down on these positions. So I kind of cut it off at 3% of the portfolio. We're not going to spend time on positions that are smaller than that. I do want to point out Of these investments that are captured in the 13F, they only make up about 46% of net assets. And I figured that out by going to advisorinfo.sec.gov, looking up Scion Asset Management, and it tells us as of the end of 2022, there was about 233 million of net assets under management. Okay, 233 million. Now, the 13F holdings, if we click to this other tab, make up, I don't know what's going on with my computer, 107 million or so. Okay, so these aren't apples to oranges. This is 107 million as of the end of Q1 versus net assets as of the end of Q4 of last year. But, you know, it's a rough approximation. About half of the value of assets under management under Michael Burry is represented by these 13F positions. So we don't know where the other half is. So just keep that in mind. This shows percent of portfolio. It's not percent of total assets. Now, just to highlight a few things, Burry is looking for these out-of-favor industries. We're going to see quite a few of these here. He's focusing on free cash flow and enterprise value, and prefers to buy within 10 to 15% of that 52-week low, with that low offering some price support. So let's get into the positions. We've got JD.com and Alibaba at the top. Now, Burry held these in Q4, but he really doubled down on them in Q1. These are the two largest U.S. listed positions. Both of these companies have a pretty recent write-up in Value Investors Club. And I'm just going to walk through a little bit of valuation as laid out there in those VIC write-ups. So JD.com, based on free cash flow in 2028, is currently trading under 2 times enterprise value to that future estimate of free cash flow. So that is incredibly cheap for a business that's growing as fast as JD.com. Obviously, investors have a lot of hesitation right now with China, with the Chinese Communist Party. You know, what are they going to do? Are they going to destroy value for shareholders? How's that all going to play out, right? There's a lot of uncertainty there. But it seems like Burry thinks that uncertainty is already really built in to the stock price, which is why he's doubled down on these two names. So one of the things Burry likes to look at is what is the price as compared to the 52-week low, right? So the price today is actually lower than at any time in the first quarter, okay? So there's a pretty good chance you can buy JD.com today for less than what Burry bought it for. Now, he may have gotten into the position through options, which may have lowered his actual cost basis. We don't know. But assuming he just bought the stock direct, we can buy today lower than what he got in for, at least this 233% addition. So that's pretty interesting. It's trading at a 15% premium to the 52-week low, which is in that sweet spot of 10 to 15%. And obviously, it's a gigantic e-commerce player in China, one of the largest e-commerce companies in the world. Okay, so no slouch here in terms of large, impressive businesses. Alibaba, next on the list, also in the e-commerce industry in China, doubled down, doubled his position in the first quarter. Based on the valuation in this Value Investors Club write-up, it's currently trading around 5 times enterprise value to free cash flow. And Alibaba has a very aggressive share buyback program. I think they've authorized $25 billion US dollars in share buybacks. So, hopefully that's going to create some value for shareholders as well. Now, it's not really anywhere near the 52-week low. It's popped quite a bit since that. It's up 53% versus the 52-week low. But Burry still doubled down not that far ago. Okay, the Q1 low was $81, and right now we're at about $89. So within 10% of that Q1 low. Next, we've got Signet Jewelers. Okay, in specialty retail, obviously a jewelry operation. Again, this has popped quite a bit from the 52-week low, but again, we're within 10% of the low in the first quarter, where Michael Burry really loaded up with a 9% position. New York Community Bancorp is number 4 on the list, thrifts and mortgage finance. Obviously, a lot of people nervous about, companies that are involved in mortgages these days. One of these out of favor industries. The Q1 low was also the 52-week low. So possible Burry got in, sub $7. It's up at $10.28 now. He may already be out. Right, he talked about in that thing on Twitter, his investment framework. He might be willing to take a 40 to 50% pop and just move on. So possibly not as compelling as when Burry invested in New York Community Bancorp. Zoom. I was surprised to see Zoom on the list. A software company pretty much all of you are certainly familiar with. Now, there's a lot of fear around Zoom, right? That it was this COVID beneficiary, right? It kind of went to the moon during COVID, and now it's coming back down. But this write-up from just over 2 years ago, in this, they were anticipating from 2021, 65% annual revenue growth over the next 5 years. Okay, 65% a year. Now that has not materialized. But if that had materialized, it would have produced a enterprise value to free cash flow ratio based on that estimated 2026 free cash flow of 1.4. Okay, that is an incredibly low multiple, enterprise value to free cash flow. Now, like I said, this has not materialized over the last 2 years. Zoom has not grown at 65% annual revenue growth. So these numbers, probably need to be adjusted. But clearly, this is an out of favor company, right? The 52-week low is around $60, currently around $66. Okay, so we're within about 10% of that 52-week low. If you look at the price chart, it's pretty scary. But I think there's a strong case to be made that Zoom, isn't just going to disappear, right? Work from home will continue, even though COVID, a lot of people are treating COVID as if, it's done, right? But even if that's the case, it doesn't mean people are just going to flock right back to work, and we're going to continue working as we did prior to the pandemic. So I actually think there's a strong case to be made. I'm not sure at what price point. Just because it's near a 52-week low doesn't necessarily mean, it's a great price. You have to decide what the outlook for Zoom is 3, 5, 10 years from now, and how does the current price, set up that investment opportunity. But this is definitely the company I would dig into first of all of these companies in Burry's portfolio. The next one, COF, Capital One, I think it's Capital One Finance. Consumer lending, right? This is kind of a scary place to be, an out of favor industry right now. with a lot of people thinking we're entering a recession, and the ability for consumers to pay that consumer debt obviously faces some headwinds if that's the case. But I see a lot of this coming up in 13F filings from Q1. So a lot of great investors interested in Capital One Finance. There's no write-up from Value Investors Club. I don't have a lot to say about it other than, it's still within 10% striking distance of that 52-week low. So could be one to take a look at. The next one, this is a mining company. I don't recall where it is. Let's just take a peek. Sibanye Stillwater. I'm sure I'm totally butchering that name. But it looks like it is a precious metals mining company in South Africa, the US, Zimbabwe, Canada, Argentina. So a mining company with pretty wide reach. Again, there's no write-up on Value Investors Club. We're basically at the 52-week low there. So, a lot of negativity around this company right now for whatever reason. Next one, Liberty. Okay, Liberty, Diversified Telecommunications Services. There is a write-up from 2 years ago. This write-up had a $31 price target. Of course, that was back in 2021. The company hasn't done what that write-up said it was going to do. Okay, it's been a lot worse than that. It was at 14. They said it was going to 31. Okay, so that's more than a double in 3 years from 2021 to 2024. It dropped to below 6. Okay, so definitely, again, out of favor. But it has popped 40% since that 52-week low. So there's a lot to unpack there. And I have zero in terms of circle of competence around telecommunication services. The next one, Cigna, healthcare providers and services. There's a pretty recent write-up, September 2022. Okay, this investor who submitted that write-up to Value Investors Club thought there was a 48% upside to intrinsic value based on the current price. Okay, it was a little less of an upside back when this write-up was done. 8 months ago? So it's dropped since then, which, if the intrinsic value is the same, there's an even greater upside. So 48% potential upside. There's also talk about how Cigna has some pretty big tailwinds based on the aging population in the U.S. There's talk about it being recession-proof as well. And I think there's maybe a 2% dividend to throw on top of that. But it is, you can see here, very close to the 52-week low. So it could be an interesting play given, that tailwind of the aging population in the U.S. Next, Wells Fargo, one of the two banks here in Michael Burry's portfolio. So, right up from 2020, okay, this is right after kind of the bottom of the pandemic, right? I think the bottom was in March. This write-up happened in July. I just want to bring something up that was highlighted in this write-up from July of 2020 on Wells Fargo. So, one of the metrics that were pointed to for Wells Fargo was price to tangible book value per share. And we can take a look at where that is now compared to where it was in 2020, compared to where it was back in 2008, 2009. So we're going to look at price to tangible book value per share. And this should pull up a chart. I want to go back. Well, first let's look at 3 years. So this captures kind of when the write-up was done back in July. It was like a 0.75, 0.8x in terms of price to tangible book value. Now we can go back much further, back to the global financial crisis, where I think it got down somewhere around 0.6, 0.7. Okay. Now, when this write-up was done in July, that was another period where it was similar to the global financial crisis. Okay, dropped below 1 times price to tangible book. We're not there now. Right now, we're around 1.1 price to tangible book. But if you look at the average over, what is this, 16 years, 17 years, the average is 1.9 price to tangible book. So we're at 1.1 right now. So, maybe this is part of Burry's thesis. If I can buy at depressed price to tangible book and, the company, it mean reverts, that can be a pretty nice price pop. And if it continues to drop, Burry probably has some kind of stop loss to just cut his losses and get out. So again, you guys can look at this Value Investors Club write-up if you want to. It goes much more in depth. This was actually a winning write-up. I think every 2 weeks, at least. I don't think they do it anymore, but Value Investors Club every 2 weeks used to award a winner for the best write-up submitted to Value Investors Club, and this one won. So it turned out to be a 2x, a double in just over a year. So for what that's worth. And there you go. Wells Fargo, 9% from the 52-week low. Obviously, there's a ton of fear in banks right now, right? So very out of favor industry. Western Alliance is the second bank on the list. Now this one's interesting. So the Q1 low was $26.12. Since then, in the second quarter, it's dropped down to 18. Okay. So if I were a gambling man, which I'm not, I would guess that Burry's probably out of this. Okay, I'm guessing it crashed through that previous 52-week low, and Burry just cut his losses at that point. Current price is quite a bit above that 52-week low, 71% higher. So perhaps a lot of the opportunity is gone in this one. And I will note, a lot of these have pretty high dividend yields, okay, like 5% or more, 5 to 10% in some cases. I don't really see that being a big part of Michael Burry's thesis, but it may, in his mind, offer some downside protection, just having that dividend that he thinks can be maintained over time. The last one, Coterra, I think Coterra Energy, oil, gas, and consumable fuels. This one may be primarily a dividend yield bet, almost 10%. No write-up on Value Investors Club. Again, we're within that 10 to 15%, range of the 52-week low. So, I hope that helps, guys. Just a little bit of information from the Value Investors Club write-ups in terms of, what these investors are seeing for valuation, enterprise value compared to future estimate of free cash flow, looking at, how close they are to the 52-week lows, seeing a lot of kind of themes here in terms of out-of-favor industries. So a lot of these are straight from the old playbook of how Michael Burry likes to find roadkill that can be polished up a bit and where he can just cut the losses if it continues trading down in price. So let's just see if I had anything else I wanted to touch on. Oh, if you guys really want to geek out over Michael Burry, you can go through some of these old Michael Burry write-ups on Value Investors Club. He put up, I think, 7 in 2.5 years, and 3 of them were selected as winners in this bi-weekly contest. And I think probably after this first 7, he was just made a permanent member, didn't have to continue submitting write-ups in order to see new submissions in real time. Greenblatt, who created the Value Investors Club, Joel Greenblatt, seeded Michael Burry's fund. Okay, so there's a lot of history here between VIC and Michael Burry. So I will link to this in the description if you guys want to go deeper on some of these early write-ups from Michael Burry. Anyway, guys, that's all I got. Thanks for watching, and I will see you all in the next one. Take care.